Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within the financial filings that shape our world. Get ready, because today we are diving into the Federal Home Loan Bank of Pittsburgh's latest report. And let me tell you, it is all about where their money is coming from and where it is going before we dive into the nitty-gritty, if you love. Getting straight up, no nonsense insights from these corporate documents. You know what to do. Hit that subscribe button now, and also join our Discord community linked in the description below for even more exclusive content and discussions. Alright, so what we have here is a Form 8K, which is essentially a report companies file when big important things happen that investors need to know about right away. This particular filing from the Federal Home Loan Bank of Pittsburgh, or FHLBank, as we will call it, talks about how they pay for their operations primarily through selling debt. Now, FHLBank is part of a larger system of 11 federal home loan banks, and they all operate under the watchful eye of the Federal Housing Finance Agency. They get their money by selling what they call consolidated obligations. Think of these like bonds or notes that they sell to the public. The really important thing to understand here is that these are not backed by the US government. They are backed solely by the financial strength of these 11 banks. This means if one bank struggles, the others could be on the hook. This filing is signed by Edward V. Weller, who is the Chief Financial Officer. It is dated the 28th of November 2025, and it is reporting events up to the 24th of November 2025. The core of this report is essentially Schedule A, which the filing says lists all the consolidated obligation bonds and discount notes that FHLBank has committed to issue or has taken on from other FHL banks. They only include those where they are the main ones promising to pay them back. They are also excluding shorter term notes that are just part of their everyday business unless they have more than a year left to be paid back. So this is mainly about their longer term borrowing. Now on Schedule A, which we can see here, we might expect to see some pretty big numbers. Remember, these consolidated obligations are how FHLBank funds itself, so they are vital. The filing notes that while these issuances are material or important to FHLBank, they haven't specifically judged the materiality of any single issuance. This means they are telling us these are big deals overall, but they are not highlighting any one specific loan as a massive red flag or a huge win in this report. They also point out that Schedule A does not cover interest rate swaps or other complex financial tools that might be linked to these loans. Plus, it does not give you the total amount of debt outstanding because it excludes those short-term notes and doesn't account for loans that might be paid off with the proceeds from new loans. You have to look at their regular periodic reports to get that full picture of their total debt. And finally, the amounts listed are at par value, which is the face value. This might not match what you see in their official financial statements because it doesn't include things like discounts or premiums. So while Schedule A shows what borrowing is happening, it does not give the complete financial picture of their debt. So what is the story here? FHLBank, a significant financial institution, relies heavily on borrowing substantial amounts of money through these consolidated obligations. These obligations are a joint promise between 11 banks and importantly are not government guaranteed. This filing details specific new or assumed borrowing arrangements, mostly those with a longer repayment horizon. While they are not highlighting any single borrowing as particularly significant, they are clearly showing us the mechanics of how they fund their operations. Now, looking at this from a broader perspective, FHLBank plays a crucial role in providing liquidity to member institutions like banks and credit unions. Their ability to access capital markets through these consolidated obligations is key to their function. However, the joint and several liability structure shared among the 11 banks means that the financial health of each bank impacts all the others. This is a critical risk factor to always keep in mind. Any weakness in one FHL bank could theoretically put pressure on the entire system and on FHL Bank of Pittsburgh specifically, as they are jointly responsible. In terms of assessment, FHL Bank of Pittsburgh appears to be actively managing its funding through issuing and assuming debt. This is standard for a financial institution of its type. The report on its own doesn't provide enough detail to assess specific financial performance like profitability or asset quality, as it focuses on funding sources rather than operational results. The absence of specific financial tables beyond the listing of obligations means we cannot perform a deep dive into numbers like revenue growth or profit margins from this particular filing. However, the key takeaway is the constant and significant reliance on these unconsolidated obligations. The inherent risk in any financial institution is amplified when the backing is solely the collective strength of its peers and not a government guarantee. For investors or those watching these institutions, understanding this debt structure and the potential for interbank contagion is paramount. The opportunity for FHLBank is to continue providing essential liquidity to its members, which supports housing finance and economic activity in its region. The risk remains that a broader financial crisis or significant distress in another FHL bank could create ripple effects. Overall, this filing is less of a performance report and more of a notice about their ongoing financial activities, specifically how they are borrowing money. It tells us that FHL Bank of Pittsburgh is engaged in the capital markets to secure funds for its operations, and that these arrangements involve significant commitments. Alright, that's our breakdown of the Federal Home Loan Bank of Pittsburgh's latest filing. What do you think about their funding model and the risks involved? Let us know in the comments below. If this deep dive helped you understand these corporate documents, better give this video a thumbs up and subscribe for more. And remember to join the Discord community linked in the description. Thanks for watching, and well, see you in the next decode.